Hello there. Part 3 of Lecture Series 22 focuses on accounting for a defined benefit plan as set out in IAS 19. Under a defined benefit plan, as an entity has an obligation to provide pension benefits to its employees, the entity should recognize a long-term liability measured at present value. The assets of the pension plan shall be measured at fair value. The entity shall offset its pension obligation and its plan asset and present a net position in the statement of financial position. If the obligation exceeds the asset, the entity shall present a deficit as a net plan liability in the statement of financial position. This is the usual situation in a defined benefit plan. However, it is possible for plan assets to exceed the obligation, and in such a case, the surplus shall be presented as net plan asset in the statement of financial position. An entity should provide a reconciliation of the movement in its net defined benefit plan liability or asset over a reporting period. Each of the components contributing to the year-on-year movement shall be discussed separately, starting with net interest component. Net interest is charged or credited to the profit or loss by applying the discount rate at the start of the reporting period to the net defined benefit liability or asset. Net interest cost reflects the change in net defined benefit liability or asset due to the passage of time. Next, service cost. Service cost charged to the profit or loss comprises of the following. 1. Current service costs. This represents the increase in the present value of pension obligation arising from employee service in the current period. 2. Past service costs. This reflects the change in the present value of pension obligation arising from employee service in prior periods as a result of plan amendment or curtailment. This shall be discussed further in the next slide. And 3. Any gain or loss on settlement. Settlement occurs when an entity enters into a transaction to eliminate the obligation for part or all of the benefits under a plan. Past service cost arises either from a plan amendment resulting in an improvement in the benefits provided or a curtailment, that is, a significant reduction in the number of employees covered by a pension plan. According to IAS 19, past service costs shall be recognized at the earlier of when the plan amendment or curtailment occurs and when the entity recognizes the related termination benefit or restructuring cost. Contributions paid are cash payments into the plan during the reporting period. This increases the plan assets but has no impact on the profit or loss and other comprehensive income. Benefits paid are amounts paid out of the plan assets to eligible retired employees during the reporting period. As payment reduces both the plan obligation and plan assets, there is no overall impact on net plan liability or asset. The net plan liability or asset after accounting for the components mentioned is likely to differ from the amount calculated by the actuary due to 1. The actuary's calculation is based on assumptions such as life expectancy and final salaries, and these assumptions will have changed from year on year. 2. The actual return on plan assets differ from the amount recognized in the profit or loss as part of net interest component. IAS 19 requires an adjustment to account for the difference. This is recognized as remeasurement component and charged or credited to other comprehensive income for the year as an item that will not be reclassified to profit or loss in future periods. The final part of Lecture Series 22 looks at asset ceiling, multi-employer plan, other long-term employee benefits, and disclosure requirements of IAS 19.